This video is purely for educational purposes. We are not SEBI registered advisors. This is not a buy recommendation. Please do your own research and consult your financial advisor before investing in the market. We will be carrying out a brief fundamental analysis of Asian Paints. Asian Paints, founded in 1947, is a multinational paint company. It is primarily engaged in manufacturing, selling, and distribution of paints and coatings. Recently, it has also ventured into products related to home decor and bathroom fittings. It is India's largest and the world's second largest paint company. It is important to analyze the industry of the company we study, regardless how great the company is compared to its peers. If the industry does not have great growth prospects, it will hamper the company's future growth. The paint industry is highly correlated to the GDP and economy. It is considered as a discretionary expense, that is, it is not a necessity. As the GDP increases, so does the spending capacity of the people as they will have more cash in hand. Currently, the ratio between organized and unorganized players in the paint industry is 70 to 30. With technological innovation and GST implementation, the market share of the organized sector is expected to rise to 85% in the next few years. Asian Paints, being a part of the organized sector, will be a beneficiary of the same. The per capita paint consumption in India is 4 kg, while the world average is 15 kg. With the growing economy, there appears to be vast scope for growth for the paint industry. We will now study Michael Porter's 5 force analysis to get a better idea of the industry. Firstly, we look at the rivalry among competitors. 70% of the paint industry is dominated by Asian Paints, Berger Paints, Nerolac, and Akzo Nobel. It is a raw material intensive industry. The distribution network plays an important role. Hence, in spite of Asian Paints having a higher market share, there is still very tough competition among the competitors. Threat by substitutes. In earlier days, lime wash was used as an alternate to paint. However, in the modern times, the trend is shifting towards paint, so there is no threat of substitutes. The industry segment is highly influenced by developments in technology, which limits the entry of unorganized players due to high requirement of research and development costs. Existing players have a very well established distribution network, which will make it difficult for newer companies to enter and compete. Paint manufacturing requires more than 300 raw materials, a majority of which are imported. Titanium oxide, which constitutes 25% of the raw materials, is facing shortage of supply. This leads to higher input costs and reduces profit. 50% of the raw materials are petro-based products which usually see high volatility in prices. As a result, the bargaining power of suppliers is high. Bargaining power of customers. In the decorative segment, similar products are offered by 4 different companies in the industry. It becomes price sensitive. As a result, the customer enjoys high bargaining power. The industrial segment, however, attracts technologically advanced companies with a robust supply chain. Hence, customers do not have high bargaining power in this segment. We will briefly read about the managing director of Asian Paints. Mr. Amit has been the MD and CEO since April 2020. He has been with the company for the past 30 years in various capacities. He was COO before April 2020. His expertise includes sales, marketing, research and tech, supply chain management, finance, general management, and other technical areas. He is closely associated with color, decor, and design. He is a member of the Color Managing Group USA. He also spearheaded the newly acquired business of kitchens and bath spaces in the home improvement venture of Asian Paints. We will do a very basic financial analysis of Asian Paints. Almost 84% of the revenue comes from the decorative segment. 2.4% comes from industrial coating business, 2.3% comes from the home improvement business, and the remaining 11.6% comes from international operations. Asian Paints accounts for 42% of the Indian paints industry, making it the industry leader. Here we look at the profit and loss statement for the past 10 years. The sales and net profits have increased every year for the past decade and have more than tripled since 2010. This level of consistency makes Asian Paints a very good company for investors. Operating profits have shown a similar trend. Operating profit margins have more or less remained the same with slight deviations. Interest and depreciation expenses are higher in the last few years due to increasing debt and purchase of more assets respectively. This is done for growth and expansion. However, the expenses are quite less compared to the profit that the company generates. Entries in the cash flow statement are made as and when cash is received or given. The profit and loss statement, however, is based on an accrual system which is easier for the management to manipulate compared to the cash flow statement. As a result, it is very important to study the cash flow statement as it gives a clearer picture of the company's performance. Cash flow from operating activities, that is CFO, refers to the cash generated from the core business. Here, CFO is generally positive, but it doesn't have the same consistent growth as we saw in sales and profits in the profit and loss statement. Here we see more volatility as the CFO has decreased compared to the earlier year a few times. This is because it is far more difficult to manipulate and smoothen the cash flow statement, and we see how much money the company has actually received in the financial year. However, in the long run, CFO has increased 3.5 times, which is a positive sign regardless of the few short-term hurdles. Cash flow from investing activities, CFI, is the cash that has been generated or spent on non-current assets that are intended to produce a profit in the future. Types of activities that this may include are capital expenditures, lending money, and sale of investment securities. Generally, growing company invest heavily in various assets for growth and expansion and have negative cash flows from investing activities. In the balance sheet, we see the reserves have risen from 1600 crore to over 12,000 crore over the last decade. Liabilities have increased as well, but they are less as compared to the reserves and other assets. Similarly, there has been growth in all the assets as well. There is not too much to study. This is a very healthy balance sheet. The shareholding of promoters is over 51%, which is a very good sign. However, 10% of their shares are pledged. Another positive sign is the increasing stake of the foreign institutional investors. On the day of recording, Asian Paints has a PE ratio of 100, which seems very overvalued. However, great companies are usually priced at a premium. It would be advisable to accumulate this stock on dips. The ROE and ROCE are pretty good. The dividend yield is decent, and the face value indicates that the stock has split in the past. The last 10-year compounded annual growth rate, that is CAGR, has been 27% for Asian Paints. Experts have predicted that in the next 10 years, the CAGR will be around 26.78%. We will use the compound interest formula to estimate the price after 10 years, taking 3000 as the base price. If we assume a 20% growth in the stock in the next 10 years, the price would be 18,575. If we take a 22.5% rate, the price would be 22,828. If we take a very aggressive CAGR of 25%, the 10-year price would be 27,939. This is not a buy recommendation. This video is only for educational purposes. Please consult your financial advisor before investing in the market.